We're grading, like, hopefully everyone just did a good job, you know? What's up, man? We did that with our drills and all, like, one of these things. And then you like combine like sector and.
They didn't even tell you yet. That's so.
Machine learning and AI. They basically, you know, trying, they sell to farm companies and they sell to. Yeah. Well, I never knew about the company. It's not follow, it was like whatever. Nancy Pelosi starts it. And then I saw she follow all calls on it.
Not following Jim Cramer, you're following Nancy Pelosi?
No, that's how I chose my company, Professor.
Did Nancy Pelosi invest in the company?
No one knew about this company until she calls.
Okay.
$2,000 of calls came in on it.
There you go. Okay, folks, welcome. And I sent an email yesterday about dates because everything's coming stacked on top of everything else. And I just wanted to make sure there was no confusion about the dates. So next quiz is on next Monday, right? 3:30 to 4. I'm sorry, 1:30 to 2. The numbers from your valuation are due on Sunday night before the last class. Just the numbers. What you got is your intrinsic value, what you got is your pricing, what your recommendation is, because I need it for that last class. Monday, of course, your project is due by the end of the day. And then I have two choices for your final exam. One is you can take it online early on May 8th. And the second is you can take it either in person or online on May 12th. I'm sorry, May 14th, the regular day, the regular final, which is the very end of the final exams week, but it gives you more time to prepare. But this way, I was trying to remove any conceivable excuses you could have for not doing well in the final, which is, you made me do it online, I could do it in person. You can take it in person if you want, but it'll have to be May. You think, what if I want to do it in person on May 8th? Well, yeah, I'm out of options. I can't create more choices here because it just gets messier and messier. So you can take it either online or in person, early or late. Yeah.
Great. There are no partial credit for
I haven't made my final judgment on the final exam. It might eventually be exactly the same kind of exam, so I'll let you know ahead of time. So if that's your choice, online versus, partial credit versus multiple choice, that might not even be an issue. The exams will all be open-ended. Basically, they will be the same kind of past exams, but the May 8th exam and the May 14th exam will be different exams for obvious reasons, right? Because the May 8th exam will already be out in the public domain. Once something goes out there in the world we live in, I assume it's public knowledge already. Honor code, not dishonor code, notwithstanding. So basically, the exams will be different. Will they be equally difficult? I have no idea. I haven't even written the exams. I don't know whether they'll be equally easy, equally difficult, just as messed up. But yet another question about the final exam.
If there is like any partial credit for.
That's why I said I haven't made the decision. The multiple choice, obviously, there is no partial credit. The one thing I have to make sure is logistically how easy it is to grade online when you have regular questions. So I'm testing that out. If it looks like I can grade the exams online quickly, so that I'm not going, then I might just give the same type of exam. So that choice might not even be the issue between online and in person. It might all be same type of exam you've seen in previous final exams. Okay, so today, excuse me. Today we're going to talk about private company valuations. As a lead-in, let's do a start of the class test. Let's assume that Jessica owns a company. And Witt is an investor in a publicly traded company. The companies look exactly the same in terms of operations, cash flows, growth. But you're trying to estimate the cost of equity for these companies. So the only excuse me. The only difference is Jessica owns a business, a privately owned business. Witt is invested in a publicly traded company. I'm interested only in the cost of equity. So far, we haven't drawn a distinction, right? In a public company, we usually are price takers. Even though you might not be diversified, you got to estimate a cost of equity through the eyes of the marginal investor in the company who's diversified. So he's betas and cost of equity. So then this was never an issue. But if you were estimating the cost of equity for a private business, privately owned business, and a public company in the same space, looks exactly the same. My question is purely one about the cost of equity. Is the cost of equity going to be higher for the publicly traded company? The privately owned business should be same. Mitt?
Private company will have higher cost of equity.
Okay, tell me why. It's the same company, same operation. So why is it that's making Jessica see more risk than Witt is?
Because the marginal investor is not diversified.
Who's the marginal investor in Jessica's business?
She's this one.
And what's the question you need to ask her before you decide what cost of equity?
Does she have other investments?
What other investments you made, right? If Jessica has all of her wealth tied up in this one business, when she looks at the business, what risk does she see? All risk, right? This is a question of what's diversifiable, non-diversifiable becomes an abstraction. So when she estimates cost of equity, she's looking at total risk because she is completely undiversified. But that's why I said you need to ask the question, because if she's let's say Jessica is really a billionaire. She's been hiding this, but she's been really a billionaire. And this is $100 million business. She might actually be in the same position of it, because to her, so it's really not a question of private versus public. It's who the investor in the business is and whether they're diversified. So today we're going to talk about how to adjust the cost of equity. In private business, in public companies, you can't play this game because there is always that choice you have of investing in an index fund. If you choose to put all your money in NVIDIA and you lost 5% of your money today, I have zero sympathy for you, right? You were greedy, you went for it. But just like the person who puts everything on number 23 in a casino table, if you lose, you lose. But in a private business, Jessica is fully invested in this business because she had no choice. She had to take every dollar she owned and put in the business because it's not like your billions coming out from somewhere else. So we're going to talk about adjusting cost of equity when people are not diversified in the private business space. Now, the other thing we've not talked about with public companies when we value them is we never talked about liquidity, right? We value the company, we came up with a DCF value. So you could have a stock company like Michael's company, which is lightly known, not heavily traded. And you could have an Apple and we treat them the same way. So are we being completely oblivious to liquidity? Or how in a public market does liquidity play out in investment decision? In the bid-ask spread, right? So if Michael finds his stock to be undervalued, he goes to his brokerage account. I'm not going to make it personal, ask him which brokerage account he uses, but there's a brokerage account, and he tries to buy the stock. The price at which he buys is going to be different than the price with the bid-ask spread. And if you have an illiquid stock, the spread's going to be wider. What does that mean? A company can look undervalued because you're comparing it to a market price. But the market price is often the midpoint of the spread. By the time you actually try to transact, you might say, I can't buy the stock. It looked cheap to me, but the bid-ask spread is too wide. So in public companies, the bid-ask spread takes care of the problem because when we go to buy or sell a stock, the prices will reflect the liquidity of the stock. But in a private business, there is this issue of if I buy a private business, there isn't a liquidity issue. It's not explicit. So what do I have to do? I have to bring in that cost into my valuation. And I call this the price of buyer's remorse. Have you ever had buyer's remorse with a publicly traded stock? I mean, here's how it will play out. You see Jim Cramer at 3:35 p.m. on CNBC, and he tells you to buy something. And in a moment of weakness, you actually buy it. And 2 minutes later, you whack your head and say, what was I thinking? This guy yells out a name of a random company every 2 minutes. I bought a company. and you decide to sell it 2 minutes later, assuming the price hasn't changed, you still have a cost. The cost is the bid-ask spread. You say, how big can it be for a stock like Apple? It can be 0.1%. But but let's say at the end of class today, you're tired. You stop at the local hot dog stand guy outside, you buy the stand. I don't know how this works out. You say, look, I've always liked your stand. You take your entire family savings. So Michael on his way out stops and buys the hot dog stand. Your savings have now been removed from stocks. You're worried about the stock market, you now own a hot dog stand. Michael gets home and tells his wife about what he's just done. What do you think your wife's reaction is going to be, Michael? What were you thinking? Go back and sell the stand right away. So Michael makes his way all the way back here and he stands on the sidewalk. And as you guys walk back, do you want to buy the hot dogs? Not buy a hot dog, but buy the stand. Much more difficult to get it off your hands, right? So what do you have to do? You've got to be preemptive. You've got to reduce how much you pay up front just to cover the cost of buyers some more. So understand the logic for why in private company valuation you apply this discount on your value for illiquidity. But having accepted that, let me ask you a question about whether that discount should vary across businesses. And I'm going to give you 4 different businesses. And I want you to tell you which ones you should see the biggest illiquidity discount and which ones the smallest illiquidity discount. The first is a money-making, cash flow generating business where you are a long-term buyer. You're not going to see your spouse for 5 years. So, I have 5 years of escape hatch before I actually have to be held accountable. The second is a profitable cash flow generating company to a cash constrained buyer where you might need the cash flows for something, a healthcare scare, a tuition payment, a house payment. An unprofitable negative cash flow business. And again, so basically a choice between profitable cash flow business, unprofitable negative cash flow business, long-term buyer versus cash constrained buyer. Let's separate the two. Okay? Profitable cash flow generating business versus money losing negative cash flow business. Which one should have the higher discount?
Money losing.
And why is that? Why do I accept a smaller illiquidity discount with a money making cash flow generating business? Because the cash comes in, but in a sense, I get the liquidity from my cash flows. Already you can see that the discount I should be applying should vary across companies. It should also vary across buyers, right? If you're a person who doesn't need cash, you don't care as much about liquidity as somebody who might need the cash. So it should vary across buyers. It's getting more nuanced already. Should it vary across time? Would you be attaching a bigger discount today than maybe 6 months ago? The world's become a lot scarier, right? There's an illiquidity issue that basically in periods where you feel scared, when equity risk premiums rise, you're going to demand more for liquidity. The discount should vary across companies, should vary across buyers, should vary across time. And this is my core problem with how private company appraisers deal with illiquidity. You know what they do? They use what I call the bludgeon approach. Every business they value, they knock off 20%. Money making, money losing, long-term buyer, cash constrained buyer, good times, bad times. We could talk about how to estimate the liquidity discount. It's one of the most difficult debates in valuations coming up, but it's got to be dynamic. It's got to vary across companies. It's got to vary across buyers. Now, one final question before we actually look at the mechanics. Let's say you own a private business. We talked about illiquidity. We've talked about diversification. You want to sell your private business and you want to find the best potential buyer for this business. Best in the sense you get the highest number. Okay? And I'll give you the choices. You can look for another private individual who will buy your business. Let's call that a private owner. You can maybe get a PE fund invested in your company. You can look at a publicly traded company. Let's stay with those 3. Which of those 3 is going to be in the best position to offer you the highest price, Michael?
The strategic, publicly traded company.
And strategic will make it even better because that will mean they'll overpay. But let's take the strategic out. What is it about the public buyer that will give you the higher value?
Well, they give you a higher value because they can offer you shares For the company.
or their investors are diversified. So they don't have this issue of not being the company doesn't have to be diversified, the investors in the company, and as a public company. And why do you not care about liquidity if you're a public company? Because you buy the asset. If your investors want liquidity, what do? They don't have to sell the asset, just sell their shares, right? Both those issues disappear. We'll talk more about why then every private company doesn't get sold to a public company. Some of them do, and it in fact explains why some businesses over time start off as businesses which are basically controlled by lots of private businesses, but eventually become public companies. Garbage disposal in the US. One point in time, every city used to have its own garbage, usually controlled by the mafia, but that's a different story. Okay? But every company is a private. Today, if you look across companies like Browning Ferris were created by rolling up the process of buying private businesses. Blockbuster video rentals, when they started, most of you don't remember. I remember when video rental companies first showed up. You'd have these mom and pop operations, they'd buy videos, random videos sometimes. And then Blockbuster Video went around town by town picking and choosing which video rental stores to buy, and they create a company. And already you can see the pieces that make a roll-up play out, because you're effectively taking small private businesses where liquidity is an issue, rolling them up into a public company, and magically you create value by just the process of rolling up. So let's go back to where I left you on the slides, where I gave you this question of, with private company valuations, why does motive matter? And talk a little bit about how that plays out in practice. So what I'd like to do is actually look at 4 sets of transactions, starting with the most difficult, private to private transactions, where one private individual owning a business sells to another private individual. Then private to public, and I'm going to give you the limiting case then, private to public, because all the problems go away. Private to IPO, where you're going public yourself, right? Rather than selling to a public company. Not every private business obviously has this choice, but if you're large enough, you've scaled up enough, you're attractive enough, you might go public on your own. And then private to VC to public. We're creating a transition point where VCs come in, they provide the capital, and then you go public. So let's start with private to private transactions and look at why private to private transactions are, in a sense, the most nightmare scenario in valuation, because all of these pieces that you don't usually deal with come into play. First, usually neither the buyer nor the seller is diversified. You know, medical practices and dental practices, almost every transaction used to be private to private. In the old days, a doctor would get to 70, 75, and what they would do is they sell their practice to a 35 or a 40-year-old doctor who wanted to buy a practice. We'll talk about what's changed in that business, but essentially private to private. Neither could be diversified because if you're a doctor, every dollar you had went into that practice because you had to maintain it. And especially the young buyer the young doctor buying the practice, not only had no assets, they had a lot of loans to pay off because they'd been in medical school for 10 years before they became doctors. And that loan hangs out over there. So neither the buyer nor the seller is diversified. Second, the investment is by definition illiquid. It's not that you can't sell it. It just means if you sell it, you got to take a big hit if you want to sell it quickly. And third, there's a key person issue. And medical practice is a perfect example. I mean, most of us, I would say everyone in this room is a doctor, right? And usually the doctor has a name and you have that, it used to be it's less so than it used to be, but you pick a person as your doctor because you trust them or you don't trust them, or they're the only one allowed by your insurance might be the reason you're using, but you're picking a person as a doctor. They're not interchangeable for the most part. It's not like you walk in, a random other person says, I'm a doctor too. It's okay, that's fine. We're all doctors, everything's going to be the same. There's a key person issue, which is when you sell your practice, that practice is built on who you are as a person. And if you buy that practice as a young doctor, the existing patients might not stay with you because they don't know you, they don't like you, they don't feel connected to you. That's something, again, you have to build into the valuation. And I'm going to argue that this isn't just private business, it's spilled over into public companies now, this key person issue and how to bring it into valuation. So I'm going to take a very simple example to illustrate this process. So let's say you're looking at a restaurant. It's an upscale restaurant, it's a French restaurant, the chef owns a restaurant, highly regarded, it's been doing well, you have the financials for the company. You're an investment banker, you're buying the restaurant. Why? Because you're tired of investment banking. You always wanted to, you don't want to cook, but you like the idea of, you've been watching a lot of restaurant shows on TV, and you watch Gordon Ramsay, said he looks like an investment banker in terms of how he yells at people. So I can do that too. So you are an investment banker, you're going to cash out, and this is going to be critical to your story. You're going to cash out all your savings and put your entire wealth into this restaurant. You have access to the financial statements. Most recent year, the company reported 1.2 million in revenues, $400,000 in operating pre-tax operating profit. It has no conventional debt. It has $120,000 in lease commitments, present value lease commitments over time. Right? So I'm sorry, $120,000 in lease commitments every year for the next 12 years. So I'm going to show you what the numbers look like from the financials. And let's say that this is not a restaurant with two sets of books. You know what I mean, right? One for the tax guy, one for you. There's only one book. They're official books that record what the company. And as you can see, that the company has reported operating income of 400,000 in the most recent year. But there's one thing I do have to add in here that might come into consideration in terms of how much you as investment bankers should pay for the restaurant. That chef, that well-regarded chef that filled up this restaurant, doesn't pay himself a salary. Why should he bother, right? It's his restaurant. He gets whatever's left over. Now, do you see why this has to be something you got to factor in? Who's going to own the restaurant after you buy it? You do, right? Who's in the kitchen the day after you buy it? Are you going to cook? What exactly are you going to cook? Structured products? Mortgage-backed securities? You don't know how to cook. You've seen cooking on TV. You got to hire somebody to do what that chef did. And it can't be just some guy off the street say, come cook some French food for me. So you got to think about what is that going to cost me and bring it in. It's just common sense, right? You got to bring it in. Otherwise, you're going to overpay for the restaurant. So let's go through this process, starting with the messiest part of the process. You need a discount rate, cost of equity and a cost of capital. And while the basic principles still apply, riskier businesses have higher discount rates, the fundamental problem here is you as the buyer. It's not about the seller. You as the buyer are not diversified. Therefore, when you look at risk, you can't look at risk through the eyes of a marginal investor who's diversified. You are the marginal investor. You're not diversified. We have to change the way we think about risk. And it's not difficult because the starting point is going to look exactly like it did for publicly traded companies. How do we get betas for publicly traded companies? We went and looked for other companies in the business and we did a bottom-up beta. I'm going to give you two alternative peer groups and I'll let you pick which one you think should be the peer group for this particular upscale French restaurant. The first is a group of restaurant companies. You go to Capital IQ, that's for restaurant companies, you get a list, right? Who are you going to find on the list? McDonald's, TGI Fridays, Chipotle, Shake Shack. First, if you show this to a French chef and say, these are your peer group, the guy won't even look at the rest of your numbers. He is out of there, right? I mean, it'll freak him out. These are fast food places. And this, so second choice I made was I asked who eats at, expensive French restaurants. Even without wine, it'll cost you what, $200 entree, appetizer, napkin. In Italy, actually, there is this napkin charge. I didn't even know about the first time I went to Italy. The waiter chased me down. The napkin charge. Oh, why did you charge me for the napkins? Because you took the table, I guess. Yeah. So $200. Who spends $200 on dinner? It's going to pass through your system pretty quickly. So you know who spends $200 on dinner, right? People spending other people's money And I'll let you list out the groups. So basically, I could look at investment banking firms as my peer group, saying if they do well, I do well. Or people who feel rich that day, they got a bonus. So it's really, it's the same kind of people who shop at luxury goods stores. So my second peer group is high-end special retailers. I walk down Fifth Avenue saying, okay, listing out that stretch of Fifth Avenue, Gucci, Ferragamo, et cetera, et cetera. Ferragamo is not publicly traded, but you go down the list. So two different groups. So you get an unlevered beta that's very different. 0.86 if you use restaurants, 1.18. I'll show you what I picked, but I'll let you think about, and I want you to open up that question about peer group. It doesn't have to be the same SIC code. You're not locked into that. You're asking about companies that do well when you do well and badly when you do bad. So now I'm going to lay out what's different. If this were a publicly traded restaurant, I would use the 1.18 beta, the high-end peer group retail beta, and move on. Right? My argument would be investors are diversified, the rest of the risk goes away, but that's not the case here. So if what I've done here is essentially taken the total risk of a company, broken it down to non-diversifiable risk and diversifiable risk. In a public company, we ignore the diversifiable risk. So we just look at the non-diversifiable risk, we capture the beta from it, we take the beta out of the regressions, and we use a bottom-up beta. But if you think in purely algebra terms, if you're exposed to the rest of the risk, your cost of equity has to be high enough to cover the rest of the risk. Wouldn't it be nice if we could somehow figure out how much of the risk in a restaurant company comes from the market and how much of it is diversifiable? Yeah, it would be. And in fact, it's there, right? If you look at the Bloomberg beta page, you notice there's an R squared and an R in that regression. What do they measure? Statistically, they measure the proportion of your dependent variable that is explained by the independent variable. The dependent variable here is the market. The independent variable is the company. So the R squared tells you the proportion of variance in your stock that is explained by the market. Hey, that's exactly what market risk is. So, in addition to getting the betas from publicly traded companies, I get the R squareds from the publicly traded companies. And I set it up as an algebra problem. If 40% of my risk is market risk and I'm demanding a beta of 0.8, but I'm now not diversified, I'm exposed to the remaining 60%. If this were an algebra problem in sixth grade, you can tell me what the beta would look like, right? It's got to be scaled up for the extra 60%. My 0.8 beta will become 2. Reflecting the fact that I'm not diversified. I concocted this measure in the 90s after I did a session for private company appraisers. And we're talking about the cost of equity. And I said, traditional cost of equity, because all their numbers come from public markets. They have no choice. They do the risk-free rate plus beta times risk premium. And I said, how do you deal with the fact that in private businesses, people who are buying the business are not diversified? And they said, we just add an extra 10%. And I said, why? I said, because they're not diversified. So why? I said, that's not why I'm asking. I said, why 10%? I said, that's what we all do. That doesn't work for me. First, it makes it a fixed number, right? Every business, I'm adding 10%. So I concocted this measure because it comes from the same public company data. And that total beta captures the risk to a completely undiversified investor.
So, the R squares are.
Yeah, same thing. I do exactly what, and just like in betas, you might, you worry about outliers. You don't have to worry as much with R squareds, obviously, because the highest R squared can be only 1. And so you don't have the range. But if you're using median for the beta, use the median R squared as well. Okay. So my total beta measure is not rocket science. It's just built on the same standards that I used to measure risk, but I'm now looking at total risk. So I'm basing your risk on your standard deviation rather than the portion of your standard deviation that you can't diversify. Beta, in fact, is a standard deviation measure of risk. For those of you who remember the original equation for beta that comes out of a regression, it's rho JM, the correlation between the stock and the market times the standard deviation of the stock in the numerator and the standard deviation of the market in the denominator. That's how we get betas. Okay? So all I'm doing is I'm taking the R squared, and the square root of the R squared obviously is the correlation, the R. dividing the beta that I get for the sector by the correlation of that sector with the market. So in this case, the 1.18 total beta that I got by looking at those high-end retailers, I also looked up the R-squares of all of the companies in that sector. The correlation was 0.5. Effectively, I'm doubling the beta to reflect the fact that the buyer, in this case, you, are not diversified. I'm not going to do this automatically. I'm going to ask who's the buyer, because that's going to drive whether I do this in the first place. That's going to push up my beta. The rest becomes more simple. You know? Basically, I start with that unlevered beta. If it's a publicly traded company, what do I need? I need a market debt to equity ratio for the company. And here I ran into a second problem with private businesses. Why? Because market value of debt, I might be able to get away with, right? You can take the present, but there's no market value of equity, bigger number. See, can I use book equity? Off the table, not even a choice. God only knows what goes into book equity for a private company, right? So you have two choices. One is you can call the owner and say, do you have a target market debt to equity ratio? You can try this. It's never worked for me because the reaction is a target what? It's a restaurant. It's some French chef. You know, what does he, he doesn't think in terms of target debt to equity. He can say, I can give you the recipe for my, my French duck. I don't know what a target debt to equity is. It never worked. The second is to use the industry average and say there's a reason publicly traded restaurants have a debt to equity and stay with the debt to equity. There's actually a third choice, which is use your own estimated value of equity to get to a debt to equity ratio. It's tricky though, right? What's the problem with doing that? There's circularity. To get the estimated value of equity, I need a debt to equity. Luckily, in Excel spreadsheet, you check the iteration box. It actually works for private companies. If you want to, you can make your estimated value of equity be the debt to equity. So basically, there's circularity, but the circularity is fixed by the iterations going around. I'm going to stay with the industry average here. The industry average debt to equity ratio is 14.33%. I assume my company is going to be close to the average because it's a restaurant. Restaurants have to have a certain amount of debt. It's usually leases. I get a levered beta of 2.56 and a cost of equity of 14.50%. Reflecting the fact that the buyer is not diversified. Any questions about the process? So essentially, I'm doing everything I do for a public company, but this added step is I bring in that correlation to adjust my beta for the fact that the buyer is not diversified. Yep.
The correlation adjustment, like an example of not using that is like if the buyer's a public company or something.
In fact, that's going to be the difference. If buyer's a public company, what should I use? Just use the market beta. What if the buyer is a venture capitalist? They're not as undiversified as somebody who puts all their wealth. They're not as diversified as a public investor because venture capitalists often tend to be sector focused. Your correlation might be 0.7 with the market, their portfolio. What if you're a private equity investor? It depends on who you are. If you're KKR or Blackstone, you're publicly traded anyway, right? So you can see that there's a continuum. I've given you the two limiting cases. Market beta for somebody who's completely diversified, total beta for somebody who's completely undiversified. Everybody else is going to fall somewhere in that continuum based on the correlation of their portfolios with the market. Once you get the cost of equity, the cost of capital follows. Here again, the easy ways of looking it up go away, right? You can't find a bond rating for a restaurant. You can look for Moody's or an S&P rating. You're not going to find the French restaurant there. But luckily, we've opened up the door. And the reason I built up to estimating cost of equity and cost of debt the way I did was I wanted to be able to deal with companies like this. So when you don't have a rating for a public company, what do? You look at the interest coverage ratio. You can get that for a private business. It's EBIT divided by interest expense. I use the interest coverage ratio to come up with the default spread, double B plus. I took that default spread, added to my risk-free rate. And here, if you want to, at the margin, add tweaks. For instance, you can argue a private business has to borrow from a bank. The banks might charge an extra 50 basis points. Why? Because they can, and you have no choice. You can add it in, but effectively, you've laid the foundation for a cost of debt. The one thing about private businesses, though, is how a private business is structured can affect its tax rate. A private business can be structured as a subchapter S corporation, which case income just flows through to the owners. You're not taxed at the business level, you're taxed as an individual, you'd be taxed as a regular corporation. So you have to know how the investment banker plans to structure it. Here, assume that he's going to stay. This is going to become just a business he owns, and it's going to go through into 1040. Is a traditional income tax return. His tax rate becomes his tax rate as an individual. So that 40% tax rate might reflect that individual's tax rate. And here you can see a problem, right? If you have very high tax rates as an individual, that can come into play in both the amount of debt you take and your cost of debt. Ultimately, the cost of capital, using my assumption that this business will end up at close to the industry average, is about 13.25%. I'm changing nothing about the core principles about how I estimate cost of equity and capital. I'm just making this what I think is a pragmatic adjustment to my cost of equity for the fact that I mean, I know there are books on how to build a cost of capital from scratch for a private business, and most of them break every rule. It's almost like to act like private businesses operate in a universe very different from publicly traded companies. But you recognize that everybody has a choice, right? You could run a private business or put your money in a mutual fund. I'm allowing for that choice and saying, hey, given those choices, that's why my risk-free rate and equity risk premium follow the same rules as for a public company. When equity risk premiums rise, so should the cost of capital for every private business. So that's the first step, getting the discount rate. You saw the additional tweaks required. On my web page, I actually have the bottom-up betas by sector, which some of you might have used that are built into my spreadsheet, but I also have bottom-up total betas by sector. So if you want to see the other end of what the cost of equity looks like, you can check that out. It looks just like my bottom. Sometimes I have people who get into that page by mistake, think they're looking up the beta for a company. And then I get emails saying, how come the beta for chemicals is 4.25? And I said, are you sure you're looking at a beta? He said, it's right in front of me. It's a beta page. I said, can you look at the beta and say, does it say total beta? And say, yeah, I saw that. I don't even know what the total is there for. It's there for a reason. It's for private business transactions where the buyer is not diversified. That's why it's so high. That's why the average beta for the market is 3.6. This is not something you'd see with the market beta, but you can see that with the total beta. So my second stop is I've got to clean up the financial statements. Some of the cleaning up is going to be what I'd have done with a public company. Like what? In a public, this was before 2019. If you're a public company with lease commitments, what did I do? I converted the lease commitments to debt. I cleaned up for those lease commitments. I did the same thing here. If the private business is R&D, I would do exactly what I did with public companies, capitalize the R&D. Luckily, there wasn't much R&D at the restaurant, so I could ignore it. But I did introduce a salary for a chef. Might seem like, that I'm hiring a chef for 150,000. I don't know what you probably have to go check out the markets for chefs. I'm probably underpaid here. I don't know. But I have to bring in a chef, reflecting the fact that I want this restaurant to be filled up. The chef not only needs to know how to cook, probably has to come with the profile that people recognize that they will come. I mean, remember, this is not just how good the food is, but who's cooking the food, right? It's this. So maybe I want to go on the Food Network and watch who's, the big names, who's recognized, hire one of those guys and pay them an amount. And that's got to be part of my expenses. So I make those adjustments. It changes my operating income, my taxable income, my net income, but this is, I think, a more realistic sense of what I'm getting as a company. My third step is going to be a tough one. This restaurant is doing well. It's getting filled up, but it's got a chef that people know the name. They come to the restaurant for the chef. Right? If I buy the restaurant and that person leaves, the question is how many of my clients will leave? You can see why this question is going to be difficult to answer, right? You got to hang out around the restaurant and say, hey, right now this guy cooks. Would you come back to the restaurant if somebody else cooked? I'm not sure you get an answer to that question. But let's assume in this case, you come up with an estimate. 20% of my operating income is going to go away if this guy's not there. If it's 100%, you know what the end result is, right? Don't buy the restaurant. It's worth nothing to you. You'll get a shell, the name, but nothing else. You know how many bad transactions would stop if you just stopped and asked the question of people buying a business and the key person leaves and takes the entire business with them? Right? So you take off 20% of the operating income. What does it do? It reduces the income, it reduces the value. If you're the chef, this hurts you as well, right? Because I'm willing to pay you less. I'll tell you a kind of related story to bring home how this can be a factor. I have 4 kids. They're no longer kids. My youngest is 26. My oldest is 35. But when they were kids, 3 of the 4 needed braces. One of them escaped that ordeal. And because I never got braces, I didn't realize how lucrative this business was. It's a repeat business. I thought you put braces on, then you came back 10 years later and you took the braces off. It doesn't work that way. It turns out every month you got to go back and they readjust the braces. I think they do it just to make you to come back. So my kids had this dentist, his name was Howie. So every month I would be the person designated to take the 3 kids in to get their braces adjusted. And Howie ran this factory of brace adjusting going on. We walked in, every chair was filled with kids' braces being adjusted. And Howie loved to talk about markets. So every time he'd come and say, can I talk to you? I have some investments I need to make, And I listen, my kids have their mouth open with somebody, you can't say, look, I can't talk now because that might be time for torture then for your kids. And Howie is a nice guy, I liked him. So I bring my kids in, and he says, look, I'm thinking of retiring. I said, you're 42 years old, Howie. What? He says, I've made a lot of money. I said, I know. I check my credit card every month, right? And he said, look, I'm planning to sell my business. And, so he said, how would I? So I led him through the process. And then I hit him with the key person question. I said, be ready for a pretty significant discount, especially because these are people bring their kids in. And if you sold your business, and some guys went in and said, and you walked in and said, who are you? And said, I'm your new dentist. You said, no, you're not. I'm going to walk out of the door. And he was, so I led him through and he recognized it was going to be a big discount, maybe 40%, 50%. And he said, what can I do to keep to make that discount smaller? Can you give him some advice? What should Howie do to make the discount smaller?
Replace yourself, resell it. So
Which is, can he have his cake and eat it? Or can he sell it? And what if he hangs around after he sells it for a couple of years, right? Get yourself a nice massage chair. You don't even have to do dentistry. Just hang out there as people come in with their kids. You make small talk. Howie was really good at small talk. Walk them over to the chair, let the new dentist in and say, this is the new dentist. I'll be around in case you have a problem. A lot of private company transactions, there's usually an overlap period between the old doctor, the old dentist, the old plumber, the old electrician, and the new buyer. So the first thing is you try to create that overlap so you don't have that key person issue. And if you're buying this business, not only do you want that, you also want to make sure that when Howie leaves, he doesn't start a dental practice next door and suck up all your patients, right? So you got to get these. So already you can see selling is not just getting the best possible price, it's massaging the rest of the process so you can minimize that drainage in value. And this is a more general issue of key persons. And this is something I wrote about a couple of years ago because this is not just in private business anymore, right? Is Jensen Huang a key part of NVIDIA? Yeah, I think so. And remember, human beings, it's not just they leave, other things can happen. It can affect your value. And the key person doesn't just have to be a CEO, right? It could be a key salesperson. Remember, in many businesses, there are some people who are really good at selling. They can account for half the sales. You buy the business, the salesperson leaves, there's half your business. It can be sometimes a key spokesperson, usually a celebrity you've hired as the person who's, that person has a scandal in their lives. Hey, they can drag your company down because people are so serious. When Tiger Woods, drove his car into the tree, Nike lost $4 billion in market cap. You say, what did they have in that tree? Why did they lose it? That's what happens when you tie your name to a celebrity, right? It could be a key design person. John Ive, big part of Apple's success, right? When you look at your iPhone now, that's the John Ive effect playing out. You can be a key production person, somebody who knows how to run a factory more efficiently, who's really, and this is the least likely scenario. It could be a key finance person. Let's face it, finance is the one area where key is really tough to think of. What can you do? Lower the cost of debt? No. But maybe if you're a private business, you have access to venture capitalists. So if you leave, in a sense, your capital flow might become more. How do you value a key person? Basically, value the company twice. I mean, I think of this as just having a lever in your DCF. This is with the key person. This is without. The difference is the value of that key person. In fact, you want to try it on a really interesting company, take Tesla and Elon Musk, right? With, without. It used to be a slam dunk 10 years ago. With Elon Musk worth a lot, without worth very little. Now it's become much more of, I don't know whether the switch is on or off, right? Because you don't know it's a good thing or a bad thing. And there might be a time where turning off the switch might give you a higher value, right? And just because you're valuing a private business doesn't mean you ignore all the stuff we talked about with public companies. What do you have to do to grow? You've got to reinvest. How much do you have to reinvest? It depends on your returns on return capital. This has nothing to do with private or public. It's just one of the laws of business. So in this case, I did assume a growth rate close to the inflation rate. Why? Because I don't want to keep building new restaurants. So you're saying, why is there reinvestment then? Because that growth is close to the inflation rate, then I have to replace my ovens, top-end ovens with new ovens 10 years from now. They'll cost me more. There's inflation in those as well. That reinvestment is small, but it's still there because I need to reinvest to keep my kitchen in working order, to keep my restaurant looking good. That 10%. I'm pretty much ready to do my valuation. I start with the adjusted EBIT. Why adjusted? Because I lowered the EBIT by 20% because the chef is leaving. I used a 40% tax rate reflecting your tax rate as an investment banker coming into play. I computed the cost of capital based on the fact that you were not diversified as a buyer and the reinvestment rate of 10%. The value that I got for the restaurant was $1.449 million. Expected cash flow next year, essentially, it's just a present. So nothing here is different from what I've done with the public company. Other?
Expected growth rate as 2%, then there is free rate. Why?
I'm sorry, what did I do?
You took the expected growth rate as 2%, right? Rather than the risk-free rate. So that's
Are you required to use the risk-free rate? The risk-free rate is a cap, right? So when you grow the risk-free rate, what am I implicitly having to do? I have to have real growth. What does it mean in a restaurant to have real growth? I can't fit more chairs in the same space, right? I can't rush you out. It's a French restaurant. I say, it's been 45 minutes. You got to leave right now. You guys are talking too much. Basically, there are only a certain amount of seatings I can do. So to have a real growth rate, I have to either expand the restaurant or add another restaurant. I can have a different business model, but then I will have to bring in a reinvestment that reflects it. So don't let the growth rate be equal to the risk-free rate for every business, because especially in a private business, you're kind of stuck with capacity constraints. You might say, all I can do is grow with the inflation rate. So my value for the equity was only $521,000. If you look at it as a multiple of earnings, it's like 2.5 times net income, 3 times net income, which looks low, right? PE ratio of 3. But with private businesses, that high cost of equity and cost of capital, and I haven't even applied an illiquidity discount yet, right? This is my value on an intrinsic value basis. Any questions about the mechanics? Yes.
You apply a terminal value or?
Yeah, I did apply. This is basically the terminal value, right? Remember, the terminal value doesn't have to be in year 10. If you're already a mature company, you can just do the terminal value today. So this is the stable growth model in perpetuity. Now, I thought your question you were going to ask is, can I use a finite life? Because in private business, let's say you have this lease for the next 25 years. You might say, look, I'm going to do 25 years of cash flows and end because I have no idea whether I can even renew the lease, right? It's perfectly okay. Private businesses, you can say, look, I'm not going to assume a perpetuity. I'm just going to use 25 years. Now let's think about illiquidity. I've already laid the foundations for thinking about illiquidity. There is an illiquidity issue with private businesses. There should be a discount on that 521,000, but it should be different depending on the company I'm valuing, healthy or unhealthy, money making, money losing. It should depend on when I'm doing the valuation. Is it 2021 or 2025? Because the market's affected. And it should depend on the buyer. Notice how much a private company valuation is a function of knowing who the buyer is, understanding it. And that's good, right? Because we talked about how much a valuation has become mechanized and how ChatGPT can do it. If you're a good private company appraiser, it's going to be far more difficult for an AI engine to do what you do, because you might not even, because you can ask a buyer, do you have other investments on the side? But most of the time they're going to refuse to. But you might look at his house and where he lives and his zip code and the car he drives and kind of form judgments about what else is in his portfolio or her portfolio, which ChatGPT will not be able to do, I think. So it is nuanced because it's very much a function of the buyer. So let's talk about illiquidity. I'll give you the standard way of dealing with illiquidity is to apply this hefty discount, 25%. Okay. Where does it come from? It basically comes from two sets of incredibly flawed studies, and I'll explain why they're flawed, of what are called restricted stocks and what happens in companies before an IPO, pre-IPO transactions. Remember, to observe the cost of illiquidity, I've got to be able to observe what people would have paid if something is liquid. And most of the time, if you look at private company transactions, what you observe is the actual price. You don't observe what they would have paid if they didn't care about liquidity. Saying, how do these two samples get rid of it? First, let me explain what restricted stock is. Restricted stock is stock issued by publicly traded companies with restrictions on trading on that stock. You can't trade it for the next year, the next 2 years. Now, I know companies issue restricted stock to employees, but you don't observe a price. So these have to be restricted stock issued to the general market. Already you can see it's rare. Relatively few companies do it, and we'll see why. But when you are an investor in a company and it issues restricted stock, it's a publicly traded company, they say, look, you can buy these shares, but you can't trade them for the next 2 years. Even though there's a market price out there, you will not pay that market price. Why? Because I'm restricting you from trading. I can observe then what you pay, and I'm getting a measure of the discount. So that's what makes restricted stock so attractive to liquidity researchers. In an IPO, there is that IPO price. So if I can observe transactions in the months leading up to the IPO, given that you're selling before an IPO, you're in a sense getting rid of that illiquidity until the IPO. You can observe how much lower than the IPO price you get and say, there's my discount by comparing what's paid to the IPO. I said they were deeply flawed. We'll see why that is. Let's start with the restricted stock studies. For a long time, every restricted stock study, here's what it did. It take all the companies that issued restricted stock. It look at the price at which the restricted stock is issued, compared to the public market price, and take that difference, and that would be the discount. And for much of the lifetime of restricted stock studies, they would take the median discount across all these restricted stock companies, and they'd come up with numbers like 25, 30, 35%. And for 2 decades, that became the basis that private company appraisers used when they went in front of court or the IRS saying, we value the company, we've knocked out 30%, look at the restricted stock studies. Until Bill Silber used to teach the foundations of finance class here. So he used to be the lead into my class about a few decades ago, decided to do a study. And he still laughs about it because it's like a summer throwaway research project where he took the restricted stock companies, and rather than just report the median, he looked at the discount in each restricted stock transaction. And he said, why are the discounts different? A very statistical and logical question answer. And he noticed that the discount was larger at companies with small revenues than big revenues. He found that the discount was larger at money-losing companies than money-making companies. So he built up a regression of, let's see what the discount is. He actually did 1 minus the discount. And he basically related it to the revenues of the company, whether it was money making or money losing. He even threw in whether the people buying the restricted stock had any special relationship with the company, because they might accept a smaller discount if they were suppliers. And he built up a regression equation. But collectively, restricted stock studies find big discounts. The discounts vary across companies based on size. I could take that Silber study, in fact, I did, and I kind of took it the extra step. I said, let's start with a median discount of 25%. Say that's your median discount. The Silber study says it's smaller for companies with more in revenues and less for companies with smaller revenues. And by how much? I just took the coefficient on revenues and converted it into an effect on discount. So you tell me how much your revenues are. Based on the Silber study, I will adjust your base discount down if you're a company with $1 billion in revenues as opposed to 100 million. I'm probably taking a coefficient and regression that's noisy and doing crazy things with it, but I really have no choice here. I also did money making versus money losing. Saying, how would I lose this? Let's say you're a private company appraiser. I walk into the private business. What's the first question you're going to ask me? Are you making money or losing money? So let's say I'm money losing. How much revenues do I have? Let's say I have 100 million in revenues. 100 million revenues, money losing company. My discount's going to be 28%. Next guy walks in, I'm a money-making company with $1 billion in revenues. Your discount is going to be closer to 15%. I'm starting to adjust the discount for who you are as a company based on your revenues and money-making or money-losing. But I'm building off a base discount that still comes from looking across all restricted stock. The IPO discount, there's some studies you look and say, I don't believe these numbers. I know they come from data. It just doesn't make sense. And I'll tell you why. These studies, and this is what they're looking at. They're looking at companies that go public. They take the IPO price. They look at the transactions that occur between VCs and the VC and the founder in the months leading up. And they document how much of a discount. And the discounts are just monstrously large. So if you look at the discount in IPOs, I don't even know whether this is the right graph in here. That's actually the wrong graph. The discounts on the IPOs are like 35%, 40%, 50%. Let me ask you a question. You are a venture capitalist in a company that's planning to go public in 4 months. Your expected offering price is 100. Would you sell your stake to me at $60? I mean, all you have to do is wait 4 months, right? There's something clearly wrong. Nobody discounts value that much for 4 months of liquidity. There's a statistical problem with each of these studies. And all a private company appraisal is built on these two groups of studies. I want you to identify what that statistical problem is first with the restricted stock studies. Where is the, because clearly these numbers look too high to be believable. Right? What do you think the statistical problem is with the restricted stock studies? First, remember what you do when you issue restricted stock? You take a 35% or a 30% discount on the current stock price to issue those shares, right? Who does that? Desperate companies. So what do you have? You have a sample of really desperate companies teetering on the edge, issuing restricted stock. You're saying, so what? Some of that discount you see with that restricted stock is really a sampling bias problem, which is if you're, I mean, you could issue any kind of equity, you're trying to raise any kind of capital. You're Weight Watchers right now. I'm not excited. People are not lining up to buy your equity. So the first restricted stock studies, the problem is, so in fact, IRS used to take these things as a given and accept them. Because remember, the biggest penalty paid here is by because many of these valuations were for tax purposes. And if you put a 35% discount on your value, that's a big chunk of taxes that the IRS doesn't collect. So for the longest time, IRS was cheap about hiring expert witnesses. So basically, the game became the expert witness for the taxpayer would come up with the high end of the restricted stock discount, 40%. The expert for the IRS would come in with the low end of the restricted stock study, which is 30%. What do courts do? They split the difference at 35%. It's a stupid game that the IRS was going to lose until finally the IRS hired somebody who knew basic statistics, who took that restricted stock discount and deconstructed into how much of the discount is for illiquidity and how much comes from the sampling bias. The fact that these are desperate. And it worked out that about 10 to 12% of the discount came from the fact that they were for liquidity. The rest came from the sampling bias. With the IPOs, you have a different sampling problem. How are you doing the IPO studies? You're looking at companies that go public and then working backwards and looking at transactions leading to the IPO, right? What are you missing when you do that? Do all companies that plan to go public actually go public? In other words, as you're looking at the IPOs that went public, but in fact, if you're doing this right, you should start 6 months ahead of every company planning to go public. And those companies that don't go public, the guys who sold early actually are going to emerge as winners, right? Because there was no offering. You're overstating the discount. I wouldn't trust the results from either study further than I can throw it, because when you have sampling bias, it can be, the studies themselves can look solid, but the sampling bias kills them. Which varies for the response from private company appraisers. What choice do we have? Where else can we observe the illiquidity discount? My answer is you can observe it all around you. Every publicly traded stock has an illiquidity discount. We call it a bid-ask spread. There's no sampling bias. I can give you, 48,000 stocks and their illiquidity discounts. And if I take the bid-ask spread as a percentage of the price, I'm getting an illiquidity discount for every publicly traded company. Sample size is huge. There's no sampling bias. It's incredibly noisy. But about 10, 15 years ago, I'll tell you why it's been so long in a minute, I ran a regression of that spread as a percent of the price against how much the company has as annual revenues, arguing that, so think of this as a silver regression across all public companies, whether it makes money or not. And I was deliberately picking variables that I could also get for a private business. Revenues, I can observe earnings. I threw in cash as a percent of firm value. Again, you can get that for a private business. And then I threw in trading volume. So you can't get that for, I can. In fact, it's zero for a private company. So this is a regression where essentially I have the spreads across companies. If I take this regression and plug in the numbers for the restaurant's revenues, the fact that it's a money-making restaurant, how much cash the restaurant has on its balance sheet, and throw in zero as the trading volume, I can get a predicted bid-ask spread for the restaurant. So what does it even mean? It's a synthetic bid-ask spread. I've made it up, but it's essentially my estimate of the illiquidity discount for the restaurant. But I now have a tool that I can use for any private company that comes in. The only problem is that regression of the spread is a mess to run because Capital IQ doesn't actually carry. If Capital IQ carried the average, I don't know why they don't do it. The bid price and the ask price, and I could create the spread. I could run this every year, just like I do everything else, update the numbers. I have to actually combine two different data sets. There is another data set of bid-ask spreads, but combining data sets, which I have set up differently, when you have thousands of companies, it's an incredible mess. This took me I thought it was going to be a one-day affair. It ended up being like 2 weeks, and I said, I'm not coming back to this for a while. I haven't come back to it ever, but maybe one of these days will be worth coming back to. But I think if my job is not private company appraisal. This is not even my top 50 list of things to do. But if you're in the private company, why aren't you doing this yourself? Nothing I've done here is rocket science. Maybe hire an intern, pay for the data, do it once every year, and you'll have a competitive advantage. You'll have a way of estimating a liquidity discount that varies. So private to private, you can see all of this mess play out. Undiversified buyers, key person discounts, illiquidity. Private to public, your problems all magically go away, right? Because it's a public company. It's not the company that is being diversified, it's investors. So you should expect to see costs of equity and capital that look very similar to what we've been using for classes up to now. The tax rates are now going to be corporate tax rates. Individual tax rates no longer enter the mix. And there is no liquidity discount because your investors, if they want to sell out, just sell the shares in your company. So if I took my restaurant and revalued it using public company data, my cost of capital instead of being 13.25% will be 8.76% market based. So it'll look like a traditional company's cost of capital. That's going to have a big effect on my value. You take out the effective illiquidity, the value of equity that I get will be 1,484 million. It's like magic. Same business, different buyer, doesn't care about liquidity. Instead of getting 454,000 for my equity, I'm getting 1.48 million. So let's say you are the chef, right? What do you think you're going to get for your business? 454,000, 1.48. Let's say that I am the potential buyer and I'm a public company. What are you going to start your ask at? 1.48. You know what I'm going to start my bid at? 454,000. And then we're going to meet somewhere between those two numbers, right? Where do you think we're going to end up? Closer to the 1.484 million or closer to the 453,000? If I'm the only game in town, you know what? I'm going to extract the maximum out of this transaction. This is why roll-ups work. Because I can offer you a $50,000 premium, act like I'm being magnanimous, say, you're going to get 450,000 the next best buyer. I'm offering you 525,000. I'm walking away with a big chunk, but what choice do I have? So if you're the seller, you're at a disadvantage unless you do what? You get another public buyer involved. Because now the game changes, right? Because now they're bidding against the other public buyer. You go back and forth. And if you're working this game right, you're going to push the number up towards 1.484 million. The key to selling a private business is finding the right buyer and getting that right buyer to start to bid against an imaginary other buyer who has the same character. It sometimes can be imaginary. You can create, oh, I've been approached by another public company, make up a name. They will try to check, but they can't check, it's confidential. But you're getting the game going, trying to get the number. But if your best potential bidder is a venture capitalist, you're not quite at either extreme, right? You can't get the 1.484 million, then you're going to have to settle for less. And there the effect will depend on what kind of total beta you're going to get with a correlation of 0.8 or 80% instead of the 50% that we use. You can see that this now becomes this very dynamic exercise of depending on who's on the other side of the table, what you end up. But if you're a private owner, you want to have both numbers, right? You got to have the 454,000 in one pocket and the 1.484 million in the other pocket. Remember which pocket you have which number, otherwise it can get really bad. And essentially start your bidding at the 1.484 million. That's your maximum. And the 454 will be your essentially you basically won't take the transaction, but drops below that. That then becomes effectively the limits that you use to try to get the best price for yourself. So private to public becomes very much like a traditional valuation. Talk a little bit about private to IPO. First, in an IPO, the private company is now going to become a publicly traded company, right? This issue of diversification becomes irrelevant because investors who buy your shares have that choice. If they choose not to be diversified, that's their problem. But there are other things that also change. First is your position as the person running the company becomes shakier the minute you go public, because now you're a public company, you're answerable to shareholders. And to the extent that you've not fixed the game, there is at least a chance now that control could change. You have to be responsive. And your information disclosure requirements will now become that of a public company, and it can be much more onerous than being a private business. Let's talk about the valuation aspect of an IPO. Right? To value an IPO, you value it like a public company. You got cash flows, you got a cost of capital, everything looks very similar. But I want to focus in on the things that are different. So I'm going to take you back to October 5th of 2013. That was the day that Twitter filed its prospectus saying it was going to go public. When I value companies that are planning to go public, I try to value them right after the prospectus is filed rather than wait a few weeks. You know why? Because no offering price has been set yet. It's a set. remember we talk about bias, the minute a price gets mentioned, whether you like it or not, it's going to weasel its way into your valuation. So you have a clean slate. You're looking at the numbers saying, how much should I value the company? This was my October 5th, 2013 valuation of Twitter. Essentially, I valued as an online ad with a story of a company that was going to be an online advertising company, a successful online, but not your primary online advertising vehicle, right? A Facebook or a Google can end up being but Twitter I felt would be something that companies would use as a secondary advertising vehicle. So I projected out revenues based on that. The original valuations there, you can read my story. But the bottom line is, until I got to the value of equity and the value per share, everything looks pretty much the same. The only difference is when I add, how once you value the operating asset, you add cash. I added the cash, and then I added IPO proceeds. What is that? What happens on the offering day, Michael?
Well, there's a primary and a secondary typically.
The primary, you issue shares, the cash from the shares comes to the company. Okay. We'll talk about what the company can do with the cash. Here, what am I assuming the company does with the cash? It keeps it, right? You say, what are the choices? We'll talk about the other ways in which the offering proceeds could have played out. Here it kept it. So the minute after you do the offering, your value of the company will jump by roughly the amount of that cash you're going to bring in. Your cash balance increases. The day Alibaba went public, its value increased by 20 billion because that's what the offering proceeds were, a big increase in cash. So that's the first thing. So the rest of the valuation looks very much the same, right? Cost of equity, cost of capital. So when you value an IPO, the real question becomes, dealing with those special issues. I want to focus on first dealing with the proceeds that come from the offering, and then talking a little bit about the debris that these companies bring in to the going public process. Because remember, they've raised capital 6, 7, 8 times before they went public, and they all leave imprints on the company. So let's look at the issues that are specific to IPOs. One is, to value an IPO, you need to know what the company plans to do with the proceeds from the IPO. And it'll be in the prospectus, so it's not going to be a mystery. You can look it up. Second, to the extent that this company has raised money from other claimants over time, venture capitalists, for instance, each venture capital round comes with its own class of security, and often special claims, options, warrants that you've given those venture capitalists to be players in the company. And all of that has to be cleaned up. And if you look at the IPO itself and pricing the IPO, you have a set of institutional issues. How are most IPOs structured? You're a private company, you want to go public, what do you do? Mit?
You'll set a lower price so that.
No, first, you don't even set a price because after all, you're a company. Before you do the roadshow, you first pick an investment bank, right? The investment bank sets up a syndicate. The syndicate does a roadshow. After the pricing happens as you get further down the process, and the investment banker makes you a promise that sounds too good to be true, which is in most IPOs they guarantee you the offering price. This is amazing, right? It's like having a realtor guarantee a price but not mention what the price is. So for the moment, it's an empty promise. We'll set a price and we guarantee it. We'll see how that plays out. But the clear thing is they're pricing the IPO. Why? Their objective of a successful IPO is clear. The market has to clear. This is a pricing game, not a valuation game. What I've done is a DCF. It's probably irrelevant in how you price this company. So let's talk a little bit about the proceeds. There are 3 uses you can put proceeds to. First is you can raise the money and keep it in the company. That just pushes up the cash balance. That's what I did for Twitter. You know what Spotify did when it made its initial public offering? It let owners cash out. People who were venture capitalists like Sony had a stake in Spotify, cashed out. So the second thing that can happen is the cash is used, so leave the firm. That's actually the easiest of all because it just transitions through the firm, nothing to deal with. The third is you can use the proceeds to pay down debt. Why would you have debt? Because you were desperate. You went out and raised that strange oxymoronic component called venture capital debt or VC debt, which shouldn't even exist, but venture capitalists often use it as, kind of, you're saying, I don't want that debt. So that's the first thing you check for. So if taken out of the firm, you can ignore it, so owners cash out. If it left in the firm, you can add, if it used to pay down debt, how is it going to show up in your valuation? If I told you Twitter was going to use the billion to pay down debt, well, your cost of capital then would change because your debt ratio would be different. Shows up in different places. As for the proceeds and so for Twitter, it's tough to estimate because you have to know the dollar proceeds you're going to raise, but that was actually in the news stories right from the beginning that they were planning to raise about $1 billion from the offering. And in the Twitter prospectus filing, they were clear about what they were going to do with the billion. They were going to leave it in the company because they had investment needs they thought they would have in the future. So none of this has to be assumed. It has to be part of it. Yes.
When you say that owners cash out, why would they?
Why would they cash
I
out?
mean, usually don't they get a big bump, right?
But they get at the bumped up price, right? So basically, so they're cashing out at the offer price. So let's assume that IPOs, companies go public at the peak of their fad status. If you're an owner, you're saying, I'm cashing out now, guys, because everything from now is going to be downhill because people are going to discover the truth about you. So a subset of owners say, this company is not worth as much as what the public market does. Some of it just might be that they don't want to own shares in a public company and have cross holdings. So there are lots of reasons people might cash out, but many of them will stay in the company. In fact, on that offering day, in most companies, many of the VCs are not allowed to cash out. They're actually required to continue to hold for 6 months or a year after the offering before they're unlocked and they can actually go trade. But some owners will cash out. So when I ask how would the valuation have been different if half the proceeds had been withdrawn by owners, would it have changed my valuation? The cash, that add-on of $1 billion, I'd have added only $500 million. Everything else in the process would have stayed exactly the same. Right? Yes, Michael.
Could there be some key person risk too? Like, I'm just thinking about, say if like Elon took SpaceX, public, but then sold, 80% of his shares, people would maybe be
The question to ask is how much of these cash flows come from having the founder around, but Elon is not at SpaceX anyway, right? So it wouldn't be as much of an issue. But you had somebody who was involved in the cash flows making a big role. When you value the IPO, you got to factor in whether the founder stays on. And if that founder is that critical, usually as part of the IPO, they will bind themselves to stay with the company because it's like it's like Howie saying, I'll stay on for 2 years after I want to retire because I want to get the higher value. Now, as I said, often by the time a company goes public, it's had these round after round of venture capital getting there, which means that you have multiple classes of securities that are built up. In the case of Twitter, at the day they filed their prospectus, there were 7 classes of convertible preferred stock. That tells me, right? There have been at least 7 rounds of venture capital. So you can almost count the number of rounds by looking at the number of classes. Facebook at 12 classes. Yeah. Luckily, in most IPOs, those get converted into shares. You don't have to worry about them as things that stay on. But they also had restricted stock units they'd been giving to their employees and was going to carry over into the new company. I'm going to count those as shares. They had 44.16 million employee options that will continue into the company, and the strike price was set. So I had to bring them in as well. So you do this with every company, but with a young company, there are multiple layers of this you got to go through. So next time you see a prospectus, read through the number of restricted stock units. It's public, it's disclosed, and you got to bring them into your share count and your value per share. So in this case, as part of the prospectus, they said the convertible preferred would be converted into share count. They gave me the share count. That share count is going to become a key component in what you attach as the value per share. And finally, let's talk about the investment banking guarantee. It sounds great, right? They guaranteed an offering price. The only problem is they don't tell you what the price is till 24 or 48 hours before the offering. It used to be 2 weeks before the offering, till about late 1980s, when British Petroleum, at that time, where the British government owned a big part of British Petroleum, they were doing an IPO where they're going to make it privatized, and the investment bankers set the price 2 weeks before the IPO, and the price The market collapsed in those 2 weeks. The October 1987 collapse happened. And one of the most pathetic shows of lack of backbone, the banks went to the British government and begged to be let out of the guarantee, saying, we didn't mean for this guarantee for a thing that's like insuring your house and then you have a fire, it burns a whole house down. The insurance company says, you know what, we didn't expect the fire to be this big. If it had been just in the kitchen, would have come, the whole house seems to have burned down. Why do you think I have fire insurance? It's because my house can burn down. And to give the British government credit, they said, no, you guaranteed it. You stick with the guarantee. But the thing investment bankers learned is 2 weeks is too long. Let's make it 2 days. Left to that, let's do it 2 minutes before. Let's see what the order flow is, and then we'll set the offering price. But they're trying to minimize their risk. But basically, if you look at the process, it's a pricing process. So if you ask me why have investment bankers set the offering price they did for whatever the company is, my reaction is they're not valuing the company, they're pricing the company. Based on what? Everything we talked about, by looking at number of users, number of subscribers. And that's why when I looked at Twitter, I said, look, I can do an intrinsic valuation of the company. It's not that I can't do it. But if you're looking at the IPO pricing, it has nothing to do with that intrinsic value. It's got everything to do with pricing. And Twitter, the pricing was based on number of users, because what else did you have? That 240 million users times $100 per user gave me a pretty good sense of what the pricing would look like. And this might have been coincidence, but the offering price was driven because your game as a banker is, and I'm not blaming the bankers, the IPO process is a pricing process because your job as the banker is to make sure the market clears on that opening. So I'm going to leave you with the final part, and this is what we're going to, this is the very last part of packet 2. So next session we'll start in packet 3. So the investment bankers guarantee a price, right? So if their price is higher than that, they're okay, but the price drops below, they've got to cover the difference. So as an investment banker, do you think you have an incentive to underprice IPOs? Yeah. In fact, every IPO handbook, you go to an investment bank, it's explicit. Price, they say value the company. What they say is price the company, and then reduce that price by 15 to 20%. And if you look at the actual IPO pricing, this plays out. On average, on the offering day, the day the trading opens, the price jumps by about 10 to 15%. This looks like an amazing way to make money, right? Which is to do what? Take every IPO, try to get in the offering price, and then sell on the first day. I want you to think about why, if it's so easy to make money on IPOs, nobody seems to make money on it. What is it about the process that makes it so difficult to take advantage of that discounting that investment bankers explicitly do? And next session, we'll start by mopping up that part, and then we'll move on to options. So bring your packet 3 after the third quiz, because we'll start in packet 3. But I will see you on Monday. And I will have office hours on Sunday, so I will send you the Zoom link so that if you have any questions about the quiz, you can ask those questions.
Yeah.